No, I think we're still near the beginning, to be honest. And that might sound pretty odd to some people when they look at the last 3 years. They say, gosh, gold's been going up for almost 3 years, October 22. The gold price had doubled. The stock prices have doubled. The stock prices are up 77% this year, the senior ones. But I think we're still near the beginning. And the reason I say that is that all of what I think of as the traditional reasons that people, investors, particularly North American investors, were invested in gold and gold stocks historically in the 70s, in the 2000 to 2009, 2008, 2009 to 2012, and so on. But the reasons that people were investing in gold historically are still not in place today.
Despite gold and mining stocks doubling over the last 3 years, most key drivers of past gold booms, such as broad-based economic weakness, low rates, surging inflation, and a tanking dollar, are not yet entirely in place. Analysts note that, unlike the one in 1980, which was brief and speculative, this gold rally benefits from a robust mix of geopolitical volatility, trade tensions, and global instability. Gold's rally appears to be sputtering. However, there's still considerable political uncertainty, and with surging demand from central banks and Main Street investors, the metal may still have room to run. Adrian, a well-known money manager, author, and resource investing specialist, notes that gold may still be in its early stages of its bull cycle. Investors are increasingly turning to gold amid rising concerns of U.S. stagflation, driven by a weakening dollar, sticky inflation, and softening labor markets. Inflation-resistant assets, such as gold, are gaining traction as protective hedges. Despite gold's gains, many U.S. investors remain entrenched in equities. The S&P continues to climb on narrow leadership, while outflows persist in gold ETFs, such as GDX and GDXJ, even as mining stocks outpace gold. At the same time, uncertainty in economic policy and weakening foreign demand for U.S. treasuries are forcing new strategies. Despite declining holdings from China, which now stand at around $756 billion, its lowest since 2009, foreign ownership of U.S. treasuries reached a record $9.13 trillion in June, supported by strong demand from the UK, Japan, and indirect investors. Measures like lighter regulation for stablecoins backed by treasuries show the government is trying to create fresh sources of demand. This shift reflects both a long-term push for looser regulation and an urgent need to support treasury markets. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support and enjoy the video.
By that, I mean a weak economy, low and lower interest rates, a high and increasing inflation, and a weaker US dollar. Now, we've had a weaker US dollar this year, but on a historical basis, it's still relatively high. But if you look at interest rates in the US, they're still high. If you look at the economy, it is still supposedly strong. The narrative is that it's strong. And so all of the economic narrative, certainly up until recently, has really been the opposite of what we look for when we look for people investing in gold. And if you look at the flows into the gold funds, for example, the GDX, which is the largest of the gold miner ETFs in the US, up until the last week, it has just been consistent outflows. $114 million has flowed out in the last month. $3.5 billion has flown out this year. When you're looking at a fund that only has $16 billion in assets, that's very meaningful. And so I don't think the U.S. investor has even begun to flow in, the generalist investor. Obviously, gold investors are in it. But the generalist investor has not even started to invest in gold yet. I mean, when I was talking about the economic environment, that really affects the interest in gold generally, gold and gold assets. But you add to that the fact that the S&P is moving up month after month after month. We all know that the valuations are high. We know that the breadth is very narrow. The market's being driven by a small number of stocks. We know that the insiders are dumping their stocks. But the index itself continues to go up month after month. And so if you're a regular investor, right, not a gold investor, you're just an investor, you're a dentist in Oklahoma City or something, your S&P is going, your brokerage statement shows that you're going up every month. You just don't see, you're just not looking at gold at the moment. Clearly there has been an awful lot of uncertainty about what policies are going to come, and then also just uncertainty about the policies, flip-flopping backwards and forwards, particularly for trade policies. Flip-flopping backwards and forwards, and that uncertainty leads to volatility, and you see that on the part of businesses as well. Businesses just not sure what to do, and when a business sees an uncertain outlook, then they're going to be much more reluctant to make new decisions. To open a new plant, to hire new people. You just kind of bunker down and stay where you are. I think to some extent that sort of uncertainty, although the uncertainty remains, I think the market is taking less notice of it now than it was in the past. But with regard to, you asked about, opening up 401ks to private equity. That's part of it. I think that's part of what you were asking about, opening up retirement accounts to private equity, opening up the passage of the so-called Genius Act that allows light regulation on fully backed stable coins. I think all of these things are they're twofold. One is they're part of an underlying sort of philosophy or approach, if you like, to sort of have less regulation and to open up markets generally. And that's certainly an approach that we're seeing after the Biden years, but also really the last 12 years, 15 years since the great financial crisis, when regulation upon regulation upon regulation has just been piled onto the financial sector. And so there's certainly a backlash against that. But some of these things have very, very specific drivers. The driver to have a light touch on stable coins, if they're fully backed by the treasuries, is clearly an attempt to find another source of buying for treasuries. Mm-hmm. Because the treasury market, as you know, a lot of the traditional buyers of treasuries, particularly foreign official buying, the Chinese government, the Japanese government, they are buying a lot fewer treasuries than they have in the past. And in fact, the two I just mentioned, Japan and China, which are the two largest foreign holders of treasuries, are net sellers now. So I think there's a drive on the part of a treasury to find other sources of buying for treasuries, and the stable coins is certainly one of them.
Despite a strong gold rally, posting its best quarter since the 1980s as it surged nearly 19%, financial advisors caution retirees against over-allocating to gold. While gold can serve as a diversification tool, its lack of income generation and illiquidity make it a less than ideal fit for retirement accounts focused on income and growth. A modest allocation of 3% to 8% is typically recommended, especially via ETFs or mining equities, rather than physical gold in an IRA. The more significant shift is that banks can now hold gold as a Tier 1 reserve asset. Holding physical gold within an IRA comes with strict IRS rules. Gold must be stored in approved depositories and handled through qualified custodians. Failure to comply can lead to penalties. Selling physical gold outside retirement accounts also triggers capital gains taxed at up to 28%, plus potential surtaxes, making proper structuring and tax planning essential. In the royalty space, the big three, Franco-Nevada, Wheaton, and Royal Gold, trade at very high valuations, while smaller players such as EMX, Metalla, and Gold Royalty are far cheaper. Juniors carry more risk due to their limited diversification, but they also offer greater upside if they grow and re-rate to higher multiples, similar to the majors. Now let's dive into the interview.
Certainly, they're opening up gold like it's a tier one asset, so banks can hold it as a reserve. As you say, we've had gold IRAs for a long time. I mean, personally, I've never seen the point of putting physical gold into an IRA because an IRA is tax protected or deferred, and so gold, which famously is an asset that doesn't pay a dividend. Well, you don't really want to put that inside a tax shelter. You want to keep that outside and put things that pay dividends inside your IRA. But nonetheless, as you say, there have been gold IRAs for a long time. But all of these shifts, with regard to the banks, for example, holding gold as a reserve, I mean, they do take time. They take time to work through, big institutions before it becomes. So we haven't really seen much impact of that of that one yet, but it just takes time to work through. Sold either immediately or within the same quarter. It's typically sold. But some companies, Royal Gold, typically or traditionally, or oftentimes, I should say, has held on to the metal longer. I think more and more of the companies, now that they have very strong, solid balance sheets, are willing to hold on to the metal for longer. I mean, obviously, earlier when you're in the business of providing capital to companies and you're continually spending that money and occasionally drawing down on a line of credit, doesn't really make sense to hold on to physical gold and silver because you can't, maybe you should be able to, but you can't use that for your next deal. But now you're seeing more companies hold on to it. And that's a good question because you always have to watch when you're comparing this quarter's earnings with last quarter's earnings and the prior year's earnings, what the timing of the sales were, and are they holding some of the metal on the balance sheet?
Got it. Yeah, that's helpful to understand. So obviously we have the bigger companies, the Wheatons, the Franco-Nevadas, the Royal Golds. What's your thought on the smaller competitors coming up in the space?
Yeah, I mentioned Triple Flag as being the fifth of the top five, Franco, Wheaton, Royal, and then a Cisco and Triple Flag. And there's quite a gap between the Cisco, Triple Flag, and the big three. And then you drop down, you drop down to sub 400 million market cap. So there's a big gap in the market in that middle area. And there's several of them at the 300 to 400 million market cap, things like EMX, Metalla, Gold Royalty. And then as you drop down, to the 50 and 100 and 150 million, there's a lot of smaller companies out there. So I do like the smaller companies a lot. I think you have to be a lot more, just as you do with exploration companies, you have to be more selective with junior ones. So the junior companies offer a positive, but there's also either a negative or something to look out for. On the positive side, the valuations of the junior royalty companies tend to be a lot lower than the valuations of the larger cap companies. So if you look at, and I'm going off my head now, but if you look at Franco or Wheaton or Royal, they're trading at 50, 60 times free cash flow. Huge. They're trading at 4 and 5 times book value. I mean, the kind of stocks that a typical value investor would run away from. If you look at things like, Metalla, well, Metalla is selling at about 60% of NAV. And so the spread in valuations between the smaller ones and the bigger ones is just huge. And so the real potential for the smaller companies as they grow is to get that bigger multiple, the higher multiple. What you've got to really watch for in the royalty space is, bigger actually is better, because a bigger company with more diversification in their assets, obviously the diversification in their assets implies or means that they have less risk from any one asset going belly up.
Even if the gold rise appears to be pausing, the larger picture of economic uncertainty, central bank demand, and geopolitical risks suggests that the bull cycle may still have a long way to go. Investors should continue to exercise caution, analyzing the advantages and disadvantages of gold as a hedge and carefully considering opportunities in miners and royalty companies with widely disparate valuations. The objective is still strategic allocation without overexposure. Despite investor withdrawals from ETFs, may central bank demand and growing geopolitical unrest propel gold into a prolonged breakout. Given their lower values and greater development potential, are junior royalty firms a better long-term investment than major oil companies? Please share your opinions by leaving a comment below and participating in the discussion. If this video was helpful to you, please subscribe and like it for future updates. We appreciate your support of our channel and the time you take to view it.